Let's talk about amazing formulas to assess financials. We'll talk about 4 categories of formulas. The first one will be profit. How profitable is a company for every $1 in stuff they sell? The second category is the competition or comps. How is the company doing or valued versus the competition? The third category is what about time? How long does it take a company to turn stuff that they create into cash? And the last section is debt. Okay, and how do we know if a company has way too much debt? All right, let's talk about profitability. How profitable is a company for every $1 in stuff they sell? So, how profitable is a company for every dollar they sell of inventory before expenses, right? That's the cost of goods sold divided by revenue. And that's also referred to as gross margin. Next up, how profitable is a company for every dollar they sell of inventory after most expenses? That's called EBITDA divided by revenue or operating margin. Okay, EBITDA divided by revenue equals operating margin. And you might ask yourself, well, I don't understand, Chris. Why don't we just look at earnings? Why do you have to look at EBITDA? Well, the reason we look at EBITDA is because if we compare and contrast companies in different countries that have different tax rates and different interest rates, etc., we can compare them. So, for example, you got Rolex in Switzerland. You've got, what's the other one there? Cartier in France. And you've got Mickey Mouse in the United States. You can compare all 3 of them using EBITDA to revenue. Cool. So next up, we've got how profitable is a company for every dollar they sell of inventory after all expenses? And that is net income divided by revenue, net profit margin, right? It's right at the bottom of the income statement. And then next up, we've got how profitable is a company for every dollar they have of assets? Well, that's net income divided by assets, which is referred to as return on assets. And similarly, how profitable is a company for every dollar they have of equity? That is net income over equity, which is called return on equity. Now, which one of these formulas uses the income statement and which formulas use the balance sheet? Okay, well, income statement is most of them, but the bottom 2 is important because this formula, net income to assets and net income to equity, uses both the income statement and the balance sheet to assess profitability. Pretty cool. All right, let's move on to debt. How do we know if a company has way too much debt? Does the company have more debt than assets? That's total liabilities divided by total assets, and that's debt to assets. And banks don't want that number to be greater than 1, right? Otherwise, they'll say, oh, you have too much debt. I'm not going to lend to you anymore. Also, does the company have more debt than equity? That's a pretty important one. That's total liabilities divided by total equity, debt to equity. And the last one is, can a company pay the interest on its debt? This one's crucial. This is called the interest coverage ratio, EBITDA divided by interest. And you want EBITDA to be many, many times bigger than interest. Otherwise, banks get really worried that you can't pay the interest on your debt. These formulas use the balance sheet and the income statement. Okay, let's move on to what about time? How long does it take a company to turn stuff they sell into cash? All right, so how many days of inventory does a company have on hand? Inventory divided by the cost of goods sold times 365 equals inventory days on hand, or DOE. I couldn't resist, sorry. All right, and basically, this is how it works. It costs us $100 to make a watch, okay? We sold 1,000 this year. Therefore, our cost of goods sold was $100,000 this year, right? That's just $100 times 1,000. All right, at the end of the year, we have 10 in inventory. 10 times 100 equals 1,000. Okay, stay with me here. Cost of goods sold again was 100 grand for the year. Inventory is $1,000 at the end of the year. Okay, we had 10 left, right? And the inventory times $100 each. All right, creative, eh? So inventory divided by the cost of goods sold times 365 equals 3.65 days of inventory days on hand. Let's talk about comps. How's the company doing or valued versus the competition? And it's tough to compare companies in different countries on all metrics. And we talked about this before. You can't just look at bottom line profitability. You kind of have to look at EBITDA because different countries have different tax rates and interest rates. But also, from an investing perspective, some companies trade at a premium in some countries for certain reasons, right? And so, for example, for years, SAP traded at a huge premium to Oracle. Why? Because portfolio managers in Germany or in Europe didn't have as many tech or software companies to choose from to invest in a while back. And therefore, a lot of them piled into SAP, and SAP traded at a premium to Oracle. And we saw this in Cognos too years ago in Canada. Cognos was a business intelligence software company that was based in Ottawa, and then IBM bought them. But it used to trade at a premium to its comps at times. And so SAP, based in Germany, traded at a premium to Oracle, which is based in the US, right? But it also did because SAP was growing a little bit faster, just to be fair. All right, price to earnings. This is the same thing as market cap to net income, close enough, right? I put a little footnote down there. We know that market cap equals shares times the stock price, right? Another comps one we look at for comparing companies is PEG, price earnings to growth, okay? Growth is EPS growth. We talked about this. Then there's price to revenue, and price equals market cap, right? And EV to EBITDA, we talked about this as well. EV equals market cap plus debt minus cash and short-term investments. And then EV to sales, same thing, except, sales is the same thing as revenue. You know that. And then we look at price to cash flow and free cash flow. Sorry, it's at the bottom of our cash flow statement. I don't know why they call it free cash flow. I mean, is cash really free? I don't get it. All right. And then they've got price to book, which we covered quickly. So book equals book value, which is basically assets minus liabilities. What's that down there? Oh yeah, tangible assets. But for the simplicity, let's just assume that it's just assets minus liabilities. Now, don't forget to account for growth, okay? A lot of times companies trade at premiums to other companies because they're growing faster. And I guess the best metric to use for this is price earnings to growth. But even when you're looking at price to revenue or EV, EBITDA or different metrics, always try to see if the growth rate of one company is higher than the other. And if it is, it usually trades at a premium multiple.